Hey guys, my name is Max Convexity. Thanks for tuning into my channel. I have a good one planned for you tonight. The title of this video is called Is YieldMax the Greatest Financial Innovation of All Time? Stick around and I'll get right into the middle of it. All right, tonight's video, is YieldMax the greatest financial innovation of all time? Of course not. Don't be silly. And no, it's not Round Hill Rex or any of the other high yield ETFs. Those are cool innovations and they've helped a lot of people. However, you have to go back to 1993 to find the greatest financial invention of my lifetime. No, it's not options. They've been around since 1973 when I was 7. Options are cool, but they have nothing on the greatest financial invention. I'll give you a hint. It starts with an S. I'll provide you with another hint. It was invented by State Street, an old Wall Street firm who currently has 1.6 trillion with a T under management. Only BlackRock and Vanguard manage more money than State Street. So what the heck did State Street invent, you ask? They invented the first index-based ETF, or the first American one anyway. There was an ETF invented in 1990 on the Toronto Stock Exchange, but the first American index-based ETF was something called the SPY. You might have heard of it before. They used to call it the spiders back in the day. 1993 was such a great time. People were wearing a lot of flannel. Kids in the suburbs were listening to Nirvana and Alice in Chains. City kids were listening to Snoop Dogg, Beastie Boys, Dre, Tupac. Country kids were all about Garth Brooks and George Strait. Such a great year for music and for culture. I had just gotten my stockbroker's license and entered the wealth management business. I loved the idea of the SPY and I sold a bunch of it to my clients. Even back then, I didn't like taking extra risk and I didn't like my clients to take extra risk. Being able to buy the entire S&P 500 index was very appealing to me. For one thing, you were instantly diversified. Institutions had been able to buy what they used to call a basket of the S&P 500 for years. Banks and institutions would trade baskets with each other. Individual investors could not, with one transaction, buy the 500 largest companies in the American economy before the SPY came out in 1993. The democratization of finance started way back when the SPY started. What does this have to do with today's video? Today, I'm going to be talking about State Street's new premium income ETFs. State Street is late to the party, but they are releasing covered call ETFs finally. Other companies like Global X, First Trust, and JP Morgan have had ETFs selling covered calls on the SPY or the S&P 500 for years now. State Street's finally joining the party. Welcome to the party. And they have some new funds that we're going to talk about today. The prospectus is 141 pages long, and I read it, so you don't have to. We're going to kind of go through and look at some of the highlights. I picked out some of the stuff that I think is important for you to know. However, I'll post a link to it so you can read it yourself, and I would encourage you to. State Street had another innovation in 1998 related to the SPY, and those are called the Spider Sector Funds. The most famous Spider Sector ETF or sector fund is called XLK. XLK tracks the technology sector. The sector funds allowed an investor to instantly put their money in one sector of the economy. Instead of in the top 500 stocks, they could put it in the top technology stocks with one transaction. Some other sector funds you might have heard of are XLF, which is the financial sector, and XLE, which is made up of the energy-related stocks. What State Street has done is to make covered call ETFs from their sector funds. So for instance, if you want an ETF that sells covered calls on a basket of energy-related stocks, now you can have one. I don't know of any other ETF company where you can do this. Right now, we currently do have something called USOI, which is a covered call type program, and they sell options on the USO ETF. And that ETF is based on oil futures, but there's no way I know of to get a covered call program of all energy related stocks until just recently. We're going to review the prospectus together. Like I say, I'm going to go over the parts that I think are important. We're also going to look at the We're going to look at option strat. Of course, it wouldn't be a max video if we didn't look at option strat for at least a second. It'll be quick though, so stick with me. One reason this prospectus is so long is because they have an individual prospectus for each of their sector premium income funds. But we're just going to look at one of them because it's standard from one to the other. The one I'm most interested in is the XLK, which is the technology sector. So the symbol for this one is going to be called XLKI. The name of it is called the Technology Select Sector SPDR Premium Income Fund. Okay, now here's some good news. This is important. Management fee is only 35 basis points. That's really competitive. The next thing we need to know about it, they tell you that they're basically going to buy the XLK, which is the Technology Select SPDR Fund. They're going to buy the XLK and then they're going to sell options on the XLK to make an additional income or a premium. With respect to the call option portion of the strategy, the fund will systematically, that means do it over and over again, write call option contracts that have expiration dates of less than 1 year, typically 1 to 2 months, with the object of generating incremental income. They say in here they could use flex options or listed options. These are really no different, and both flex options and listed options are guaranteed by the OCC, the Option Clearing Corporation. Very safe, very transparent. I like this. The fund seeks to optimize the return from its use of call options by setting strike prices based on the sensitivity of options value to change in price, time, and volatility, known as the options delta. So this is easier to show you than to read the prospectus on. So really quick, we're going to go to option strat. I pulled their current holdings of the XLKI. Right now it only has $1 million under management. It just started. They have 3,800 shares of the technology sector, the XLK. That's their long position. In a covered call, you have a long position, which is the stock, and you have a short position. You're selling calls, that's a short position. Their short position is the September 25th expiration, 275 calls. So that's about a 7-week time period. These started on June 1st and they're selling, July 1st. So they have all of July. Start on the last day of July 31st. So they have all of August and 3 weeks in September. So these are about 7-week options. You guys have probably heard before of the Tasty Trade methodology. They're real big on selling options that are about 6 weeks out. I would say that this is similar to the Tasty Trade philosophy, just based on what little I know. So they have 3,800 shares of stock, and then they have their short, negative right there, 38 contracts. That is equal. 38 option contracts short equals 3,800 shares of stock. Okay, so let's get into option strategist really quick. I loaded up the position here. So you can see the XLK, that's the index, that's the ETF they're selling the options on. So they own 3,827 shares of this ETF. Today it closed at almost at 368. Almost at 268. Actually, 267.74. What these guys have done, they've gone out till September 25th, and they wrote the 275 strike call. Okay. The current price is at 267.74, like I said. This means, and you can see this on the graph, if the stock's price goes up, they make additional money and they get additional NAV return until it gets to 275. Then at 275, this position is what's called capped out. This option position has a maximum they can make of $43,250. Now, the thing is, when they sell this option, it's going for about $4 today. They received a credit of around $15,000 for selling this option. but they can also make money from the NAV going up from 267.50 to 275. And if you add that up and you subtract that credit, or if you add up the distance between 267.74 and 275, and you add the $15,000 together, you're going to get $43,000. That's as much as they can make. That's what's called capped out. But the good part about the strategy is if the stock goes nowhere, they make this position will be worth $15,000 at expiration, even if the stock goes nowhere. The other good thing about selling options is because they received about $15,000 for these contracts, if the stock goes down, the first $15,000, they don't realize a loss. So the stock has to drop more than 1.5% before they start losing money. That's called the buffer. This is the advantage of covered calls. We talk about this all the time on the program, but this is the basic setup of their fund. So they get the first 1.5% and they don't lose money. But then after that, they lose money just like they would if they had the stock, because they do have the stock. They have 3,827 shares of the stock. They just get credit for the first $15,000 because they sold this option. Okay, so let's go back to the prospectus. That wasn't too painful, was it? It says in here, the advisor will typically roll the short option position before expiration, taking into consideration market and liquidity conditions. One other thing is if before expiration, if the fund goes, if those options go in the money, meaning they're capped out and they can't make more than that initial $43,000, lots of times in that case, they'll also roll, which just means closing that first option and using a new option. On the next option, they may go out to 285 or 290. That's why it's called rolling. They just roll it out in time. And sometimes they roll it out in time. Sometimes they roll it out in price and time. Sometimes they just roll it out in price. That's their job. They handle all that stuff. All right, principal risk. This is all very standard. Call option strategy risk. We've covered this. I cover this stuff so much on my station. I don't think there's really much additional to learn from that. If you're a Max viewer, we talk all the time about the ins and outs of covered calls and what they do for you and what they can't do for you. This prospectus just restates a bunch of that. I thought this was interesting. Additional strategies information, and I don't see this clause, this paragraph too often on other prospectuses I evaluate. Let's go to the non-principal strategies. The non-principal strategy says temporary defensive positions. In certain situations or market conditions, the fund may temporarily depart from its normal investment policy and strategies, provided that an alternative is consistent with the fund's investment objective and is in the best interest of the fund. Temporary defensive positions may include, but are not limited to, cash equivalent, government securities, repurchase agreements, money market funds, high-quality debt instruments. If a fund invests for a defensive purpose, it may not achieve its stated investment objective. In addition, the defensive strategy may not work as intended. Most, or I don't want to say most, but the YieldMax spreadsheet says exactly the opposite. It says they will not take a temporary defensive position. So I thought that was interesting that these guys will take a temporary defensive position. I'd encourage you to read this yourself. They have a lot more details in there. I'm just trying to cover the highlights. I know your time is valuable. Let's go to the distributions. I know you guys like to hear about the distributions. They're going to be monthly. It states in here they're going to be monthly. This is usually pretty standard stuff here. It talks about income dividend distributions, if any, are generally distributed to the shareholders monthly, but may vary significantly from period to period. Well, we're used to that. It also says they may pay you some return of capital, but they'll tell you how much it is after you get it. Something else that I found to be a little bit different than reading the YieldMax prospectus is this right here. It says, as a fund shareholder, you are entitled to your share of the applicable fund's income and net realized gains on investments. It seems like there's other funds out there that pay you on the gross realized gains of investments. Each fund pays out substantially all of its net earnings to shareholders as distributions. Each fund typically earns income dividends from stocks, interest, and debt securities. Additionally, the fund may also generate incremental income from selling the call option contracts. These amounts, net of expenses and taxes, are passed to the fund shareholders as income dividend distributions. Each fund will generally realize short-term capital gains or losses whenever it sells or exchanges assets held for 1 year or less. Net short-term capital gains will generally be treated as ordinary income when distributed to shareholders. Each fund will generally realize long-term capital gains and losses whenever it sells or exchanges assets held for more than 1 year. Net capital gains, the excess of the fund's net long-term capital gains over its net short-term capital losses, are distributed to shareholders as capital gain distributions. Net capital gains each fund are distributed at least annually. Dividends may be declared and paid more frequently or at any time, but they say in here they aim to pay dividends monthly. Here's my conclusions. These ETFs are going to pay about 6 to 12%. And that's because they're selling long-term options. And let me show you what else I'm basing that on. Look at this position they have on in this one fund right here. For what it's worth, we can multiply 15,000 times 6 because this is almost a 2-month option. All right. So what does that equal? 90,000. And this ties up $1 million. That comes to 9%. I think that's going to be a good proxy for what these are going to pay. I think these ETFs will have around 6 to 12% yield. And it's because they're selling longer term options. YieldMax and Roundhill and others sell shorter dated options. Shorter term option strategies, i.e. daily expirations and weekly expirations, create more yield, but can wreak havoc on the net asset value of a fund. I would expect these ETFs to compete with Global X and JP Morgan's of the world. State Street also has a super low expense ratio of 35 basis points, which is very good. These funds should have decent NAV return, but fairly low dividends compared to the funds I usually talk about. So what do y'all think? Are you going to buy any of these? I'm going to have a follow-up after these have been out for 6 months to a year, and we'll see how close my prediction is on the yield. I will also track these ETFs in the Max Factor, which is my proprietary metric for evaluating these high yield ETFs. From Hill Country with Love, Max out.